housing.
Yeah, or housing. So I think it's important for everybody to just, like you said, stick to their rules, right? You have to have rules-based, investing and discipline and stay focused to what your core is. If guys are gonna do, private debt, then, vet that out and do it properly and do right. It's a time in the cycle where you're not gonna throw a dart and make it 10x, right? You're gonna have to do your homework, stick to your due diligence and make sure you're playing with valid players and, and hope for the best. But I do think there's opportunity out there.
Okay, all right, good. Yeah. Glass half full. Let me change the bent or the slant of the question. Is there less competition for deals out there, given that money is so tight, amongst other capital allocators? And Rick, you can take this, or whoever can take it. Just because people are talking about you have to be more stringent as far as your rules and as far as your diligence goes. But when there's more people that have less access to capital, or more companies that have less access to capital, you get to be a little bit more choosy. So does that change things at all?
I think it depends on the size of the market you're in. There's a huge amount of money that's come into the private debt market. I mean, Bloomberg today did the Apollo show, live from the Apollo, that everybody from Apollo, and all Apollo can talk about is private equity's dead, private debt will live forever. Mark Rowan cannot stop effusively talking about that. So there's a lot of money flowing into the sector, but private debt's divided into really large guys and really small guys. You got people who are doing $100 million funds and doing $3 million private debt deals that they vet just as hard as anybody else. They're ex-Goldman Sachs guys, they're starting a new fund, but this is their second fund. Those deals we like. They're senior in the stack, they put a lot of effort into the legal side, and we've done probably 50 of those deals in the last 24 months.
What's the duration?
Duration is usually 3 to 5 years. No real extensions. I'm still ferreting out my Lehman Brothers real estate deals. My son said, you'll be dead when that pays out. Long dated deals are a problem. Marty's right. I mean, something that our group has talked about a lot because most of our members are now over 70. We have deals from the crash, that are still alive and kicking and paying fees. They're not paying any money, but they still have assets. So what happens when you have long business cycles and then a bad business cycle in the middle of it is creative lawyers like I allow you to keep calling money to pay back problems and management fees up to 10% more, and that's what's been happening. But I'm not sanguine. I don't know why you said you were completely opposite to me. You weren't. I think that you can take advantage of the higher interest rate market. I think it will be higher for longer. I think part of it is the size of the debt. And I think the one thing that people aren't factoring into where we are in the economy now is the amount of wealth creation during COVID was the greatest in the history of mankind. Yeah. As many 500 millionaires and billionaires were created during that period than existed on the face of the earth. A lot of those people now own equity that's worth nothing, or in bankrupt companies like one that I've gone after in my case, where 2 people sold $400 million of stock in an IPO. 2 years later, it's insolvent and liquidating for nothing. But there was a huge amount of wealth creation which chased assets. Apartments right here in Miami Beach, Rolexes, Aston Martins, antique cars, art. That's over. And the question is, what happens to all that money? How does that difference between 10 and $32 trillion come out of the market? It hasn't come out of the market yet.
So can we just change the verbiage from wealth creation to nominal wealth creation?
Okay. Yes.
Right? And someone at the Sal ran a conference last week, and Rosemary Sager, who's an honorary member of your group,
yes,
spoke, and she was talking about 18 to 36 month duration credit.
Oh yeah.
So yeah, so, I mean, there's like a common thing.
I actually want to use Marty's interjection as an opportunity to just let's make this interactive. If you got questions or comments, it's the last one. Let's get weird with it. That's why we have Marco here. That was your segment, by the way, to address the question.
Me?
Marco.
Listen, when it comes to this, we're 120 years legacy and 4th generation family office. So our mandate, obviously, is to not just continue maintaining our wealth, but grow it. So how do you grow it? And I hear the narrative, and I just don't agree. the idea here as a family office member is to get involved with your family, roll up your sleeves, get to work. But there's so many different factors that could potentially back trigger onto all this investment, even if it's private debt. We're not lenders. I hate loans. I'd rather, build a company from scratch and get involved and use all of our influence as much as possible. Somebody wants to give me free money, that's a different story. But I'm very optimistic that we're gonna be better off.
Yeah, I mean, try to find one person in this room that wouldn't like free money. Free money? Okay, cool. I thought there were a few. Sal.
There's still money out there, but I think everything is starting to, sort of, group up on the private debt side. About 10 years ago, I wrote my first book on real estate private money lending after bailing out a lot of hard money funds that went under. And there was a whole credit craze that went on there too. And I think a lot of people lost money. That's a very low barrier to entry business to get into. The name of the book is Making the Yield, by the way. And it quickly went as high as $1,800 per paper book on Amazon for the paperback. Not going to sell a book right now, it's available on Amazon. However, you're starting to see people now, it's the same, cycle, the ephemeral, it's like everything just moves from private credit and then I'll go back, if interest rates move downward, like you and I were talking about, then that could spur other types of, more speculative type of investments. But I think if you're sticking with quality, you're not going to get hurt. It's interesting to see what's happening right now in the markets. It's, I was talking to someone the other day, what we've seen come out of zero interest rate world for the past decade and a half has been things that nobody would really ever invest into, like a $150,000 NFT or something, right? So, people are starting to learn today what assets are, what they look like, what they aren't, and the quality of the sponsors and the managers behind it. And that's what we follow. And we work with a lot of emerging families that have just come into their own. So the guidance we give them to protect them has really been instrumental for that. But we just stick with our rules. And that's why we haven't had any problems when Silicon Valley Bank was blowing up, when interest rates went up 550 basis points over the past, 18 months at least. So it's interesting.
So I see a couple people in this room that have heeded my call to action. The gentleman with the HP laptop, by the way, respect, PC, no Mac. Had a question about HP. I'm the dumbest.
Oh, yeah.
That was a trust exercise you passed.
So I think the surefire way to lose money is to follow the herd, right?
Well, you're seeing that in private credit right now.
But that's not the first time. We over and over and over. Wall Street builds something up, they fatten up the pig until it explodes. Everyone loses money. They win the market. Then they do it again and again and again, and we'll continue to do it again. Because the alignment is completely different. The transaction oriented, they want to make fees. We don't want to make fees. We want to make money. So yeah, but we got to be brave enough to have. You got to know what you're good at. You got to know your specialities, and we different families. As I said once before, one family, one family. And I think we work on that and figure out what we can do. We always got to be creative, intellectually curious, keep finding new things, as well as know what we do, can expand. Expertise, we can expand our regions, but if you just listen to the market, it's great, you'll lose money, I can guarantee you.
Well, you got to remember that the equity market is meant for the retail investor who's the middle class guy. So those guys are speculating on everything that they invest into. I can tell you after writing my third book, doing research, women buy 70% of books on investment. Guys just read Reddit and Instagram. Because it's the middle class that gets fleeced, not people in this room, generally speaking. There's a level of sophistication there where you're not seeing people go ahead into, things like they did in 2001 with new IPOs with no earnings. Remember Jim Cramer? You don't have to worry about P&E because there's no E, right? Look at him. If you follow everything he did, you probably would have lost everything. But now there's inverse Cramer, EPTs, and everything that people use to bet against him, which I think is hilarious. But that's for a different class of investor, I think.
Okay. I don't know if anyone else want to respond to that. I respect that. I'm not even sure that was a question. But if we got another participant.
Well, a different question, but that's not true. Public markets aren't just retail markets. But the question for each of you is, given the size or the growth in the private markets, in particular the secondary markets, And I guess the expansion of some of the funds, even think of infrastructure funds, which now kind of cover private equity and real estate. Do you see the potential for much higher correlations now with public and private markets, in particular, given how large the secondary markets are? How much money is going into that, with the secondaries being some form of an exchange or arbitrage between public and private markets? So do you see the correlation just rising really across the spectrum in terms of all these asset classes that now are all quite well funded or quite deeply funded?
I can talk about a correlation that I understand right now. The S&P 500, half of those companies that are listed today will be delisted to the fact that they are not adapting fast enough to technologies. And we've seen a lot of companies going belly up because of that reason. That's a correlation that it's impacting private to public markets directly, and keeps on happening. So when are we going to wake up and say, let's take the chance, let's go and disrupt markets by investing money in disruptive technologies? What does it take for you to understand that we need to be a part of that?
I think what he's talking about, and we did this with SpaceX and we're doing it with Stripe, is that there's so much transparency now with these companies before they go public formally that they're issuing information rights. If you have over like a 8-figure investment into it, which one of our families do that we're working with on this one. So that you're starting to see like the efficiency come, you know what I mean, where like the secondary is trading like a primary, so yeah, that's definitely happening. And I think that's just part of the process, in that, how technology and all of this is adding to transparency for, finding basically value, right? Or, getting what do you call it, pricing, information in real time for this stuff.
Anyone else?
I'll let anyone else that wants to respond.
I heard the comment about retail, and I'm sorry to say this, people, but retail was right this time. My ex-girlfriend, who's never read a book on investment, and probably never read a book, invested in the Big 7 and doubled my returns, and can't stop telling me about it. So I totally disagree with what you said. What we have is a completely correlated market, driven by low interest rates, driven by monopoly power of those Big 7 companies, or oligopoly. And if you did that, and I didn't, I admit I'm probably the only person who's ever at the Marty conference admitted I've lost money and not every investment I did was good. I admit it. You did very well. And I don't know why people would say I like private equity better than private debt. That makes absolutely no sense to me. You're senior on the stack. You don't have the equity level risk. You undo the same underwriting process you did before. The amount of debts in these deals is not that high. So if the next cycle is going to be rougher because rates are going to stay at 500 bips, maybe we have a slight recession, Europe's in recession, why would you want to be on the private equity side when we don't know when the next IPO is going to be, and we don't know if there's going to be an M&A market for the rest of our lifetime?
Maybe one way I put it is that the growth in private credit is probably less than 10% the growth in the pullback of banking credit. I mean, there's been so much pullback in bank credit. We fill the gap.
We had a big meeting with a very good manager in regional banks, and he's gotten killed. He's lost 22% last year. And he said, I've lost a lot of money. I'm taking all my money and doubling down, because the next business cycle in the US is bank mergers.
Yep.
They cannot make enough money on their own. We have to go from 4,500 banks to 1,500 banks. When that starts, I can't tell you, but it's going to start.
I think somebody at Sal's conference was talking about how there's a real big bank crisis that's undercover because everybody's taking advantage of this Fed revolver line, right?
Yeah.
But that's going to lead to the next, and it's happened before, and you can make 100% in 2 years, and then you get out, and books paying 95% a book now, all of those banks. They go to 120, 130 in acquisition. And is it going to start tomorrow? Not because I said so, but it is going to start. So the macroeconomics haven't affected, in my opinion, the sort of mentality of the Big 7 that they can sell it 40 times, even though they're giant companies. And it certainly hasn't affected the no earnings, high revenue companies. This week at our meeting, we take a balance sheet, an income statement, and we don't put the name of the company. We say, what company is this? So this week, our company is, don't come to our meeting, is Coinbase. Have you ever looked at the financials of Coinbase? By the way, when they were alleged to be an illegal operating securities exchange like a year ago, 20 people wanted me to sue them and put them out of business. And they now have a $28 billion market cap, no earnings and nothing in prospect. So that's a theme stock. So we've had theme stocks, and then we've had the big seven. That's low interest rate trading. The rest of the market's been flat. I think the next cycle is flat, and then private deals, which are not accessible to retail, so it's got nothing to do with retail investors. They're $1 million or $1.5 million minimums. That's not your average investor. Kind of a diversified portfolio, so you're talking people investing $20 to $50 million. And I think that is a decent trend going forward unless we hit a super deep recession. That's my opinion.
Before we get to the next question, I did promise it would get weird, and I did not have on my bingo card a story about an ex-girlfriend outperforming a lot of people in this room.
You have the same girlfriend.
Huh? No, trust me, you should have seen her balance sheet. That's why we're not together anymore.
She was reading Sal's book, bro.
This is being recorded, right? No naming names.
Was she blonde?
She blocked.
Yeah, please.
Hey-o.
I didn't say that. This is about one person. We have a question over here.
Can you talk about how to establish credibility and confidence between families that the family office that is leading the deal or proposing the investment is not essentially using the other family offices to de-risk or be their liquidity? So what do you put in place to establish that sort of credibility so that all family offices trust each other and don't feel like they're the sort of schmucks, the last schmucks at the party?
I think from a European perspective, especially building relationships and Europe and Asian markets tend to have the same approach. Relationships are the most important things, whereas in the US it's mostly about numbers. The credibility, the trust comes from spending time with such families, inviting them to see what you have built over a period of time. In our case, it's an advantage that we have tradition in place, right? The history, the legacy, and so on. So showing them really what we have and learning about them and integrating whatever infrastructure they potentially can have to optimize any business within your company. That's how we approach it.
I think today with families, and we work with a lot of second gens, interactivity is new currency. If you get on my email list, you get an email once a week, and you're also invited to come to an event that Marty was at last week. And we foster that intimacy so that everybody can see each other and you know, sort of touch the cloth. There were some very high profile investors there, as Marty mentioned. Rosemary Sager, who's a legend, and now everybody wants to invest alongside her because she was able there to meet and talk and really interact with these people in real time. I think today a lot of people take a transactional approach, and I only have 13 families that Albert and I work with, but they're very responsive because we're very interactive with them. And that's part of building a relationship. And I think a lot of things today, family office is a term that's been used and it's been abused by broker dealers. But really, you know, if you're able to show, it's a little more of alignment of interest. It's like you gotta be courting these families like you for marriage, right? It's a long-term relationship. And I think with Bitcoin and everything coming down here, people got way too transactional. And when you move too fast and you're too transactional, you don't know who you're working with, you get stuck with a guy like Marco, which might be a good thing, or a great thing, or you know, you get stuck with someone else.
Whoa, I'm the one that's allowed to make Marco jokes.
But you know, it's in the quality, and it's how often do you talk, how often do you interact with your member families, right? If you say you send an email once and it says dear investor once a quarter, you're not building relationships. You're trying to be the next, like, you know, fiduciary or something like that. So, you know, to us, it's and they like that. And everybody's on social media today too. We were out with some of them last night at Dom's, a little late, but you know, these guys, they like that interactivity because they grew up with it, and that's what they're used to. And if you don't hear from you, they get a little worried. And that's going between, you know, up to ages of 60. That's just very, very basic.
My only comment is I have to say I've known Sal 15 years, and he really takes an artisanal approach towards his clients. You know, and high touch. It's important.
No, it is important. Yeah. I mean, that's what I learned at Goldman Sachs. It's coverage banking. You stand there. You're not on top of your clients, you're fired. So, I mean, why not do this with the families?
Right. You have children, have your children meet the children of the family that you're looking to do business with, because that's the future. And that's going to give you that, you know, mindset that is needed to continue business.
What I found is that, you know, in the early 80s, when you had the tradition of the first wave of hedge funds, right? And then, of course, to your point earlier about Wall Street, whatever, hedge funds became very numerous. They were all over the place, whatever. And you've seen a similar trend with family offices, right?
Yep.
Family offices used to be, very secretive, huge families with, brand names that everybody knew. And now, courtesy of kind of the wealth creation and also just the way the world has worked, some kind of tax strategies and also the ability to do it themselves because of the technology and being able to do it, you've seen a proliferation of family offices. So I still think the family office market is incredibly fragmented and Wall Street's trying to treat it as like a market, but it's very fragmented. You have like a group where I was at, where we were just doing non-correlated private equity. Then you could have guys that are doing the full gamut where they're managing property for people, booking airplanes for all the family members and running vacations and doing all that kind of stuff, all the way to the, the right hand where they're just managing the philanthropic side where they're just giving money away. So the catch-all family office has a lot going on in it, right? But to what you guys are saying is now that they've all proliferated and you've had generational wealth created in the last decade or 15 years or so, people are now able to get the second and third generations, to start working together because that's what they're going to be doing is carrying on the legacy, right? And interestingly enough, when the Ivy League used to be a place where all the scions of industry sent their children so that they could all meet each other because they were going to all sell each other cogs and widgets to each other in the next generation. So we've kind of come a little bit full circle in terms of wealth concentration.
It still is,
right?
by the way.
Yeah. A little bit more meritocracy, but yeah, it's there.
The feedback is getting to me. So Chris, hold on a minute. Because, contrary to me jabbing you about being a pessimist, I think no is actually a pretty good word sometimes. And I think, so I guess I'm curious, when you're advising families or when you've been part of a family office, sometimes you have to say no, especially to maybe the next gen, et cetera. What is an instance that you can think of, or maybe just an archetype of an instance where you had to say no, where you've been vindicated, and then an instance where you said no and you're like, shit, I wish it was yes. Actually, pardon my French.
Well, with me, one of the biggest thing that I was doing was for my particular guy that I was working with, I was kind of a gatekeeper, right? Because I was amazed, like I would never in a million years reach out to some of these kind of billionaire guys, and I was shocked over the last 8 years at the quality of some guys that were actually able to get into the room, right? And I completely put a stop to that. He would come out of the office and he would say to me, "Hey, Chris, where's our 10 o'clock?" I'm like, I threw him out because he just wasn't a quality guy, and I felt that you really had to be a gatekeeper for that. So in terms of saying no, I think it's like for those of us who are supporting family offices, right? I think that's part of your mandate there, working with them is helping them, because everyone's, why do people rob banks? Because that's where the money is, or at least historically it was. People are always going to be out there. You have the money, so you're going to be getting a lot of inbound phone calls and whatever. The flip side to that is on the investment side, right? You have to make sure that you give every debt its due, right? And, at least for what we did, because the last thing you want is to have a 10X on your desk and you missed it because you just, your gut said, don't look at it. So you do have to run that through the process just to make sure that your gut was right, because you don't want to, you don't want to have to, say that, oh shoot, I missed Uber.
Yeah, thank you for the shoot. Yeah, I'm not an expert guy. I'm more of a Jerry Seinfeld kind of comedian. But okay, I had a follow up. I got wrapped up in my own joke. I'll let anyone else address the no question. Actually, here was the follow up. The follow up was, what's the most ridiculous company pitch that ever got through the cracks that led into the room that you can remember?
Oh, there was a bunch. I mean, well, I would say we actually ended up putting money, against my best wishes, into one of these esports leagues, right?
Oh, okay. Yeah, I can empathize with that, sure.
So, and we got it actually from a very reputable New York family, and that didn't go through the right process because everybody was, that's why I said you gotta stick to your rules, right? Didn't go through the process because everybody, oh, these guys gave it to us. The next thing you know, you're on Instagram and you're seeing these guys, you know, hanging out with every NBA player in Los Angeles, in LA. The next thing you know, like they're gone. So we were kind of like, where'd everybody go? So we had to try to track them down. So that one was a little bit bust. See what you were saying too, you just can't follow her, you gotta stick to your.
Yeah, I think whenever you depend on the veracity of one person, that's tough. And the other thing is that FOMO is the enemy of rationale.
Oh,
Yeah, I mean, don't load up an AI, right? Wait till AI 2.0 comes up, right?
I thought you were about to go into a story where you're like, well, this guy named Sam Bankman-Fried walked into my office and he told me on a bill of goods.
No, he would have been one of the guys I throw around.
Okay, all right. Rick, I mean, I like this question, not just because I asked it, because I think there's fun stories.
Worst deal?
You could call it the worst deal, or the one that you've seen, you didn't necessarily have to have done it.
Without naming names, brought to us by the daughter of one of the founders of Carlyle Group. Oh boy. A company called Vital Farms, allegedly doing humane and ethical treatment of chickens on the farm, so that you'll pay $9 a dozen instead of 99 cents a dozen for the same eggs. Had a big appeal in Boca Raton, Scarsdale, places like that, and they ran their revenue up to about 100, 200, now it's 400 million. They still don't make any money. But the problem is they're lying, and it's not humane and ethical, and it's nasty agribusiness where chickens live 12 months instead of 10 years. And sorry to tell you, this is other nasty things that I won't go into. So that company will disappear from the face of the earth soon, even though it was basically the child of the Scion of Carlyle. So yeah, we see big deals like that also that came out of it. All of the deals that I'm thinking that were bad, there's another one that's now in bankruptcy, all came out of the COVID rush, where any business idea attracted money at zero and was being pushed by Wall Street. Yeah. And we're still at the beginning of that bankruptcy cycle. I mean, the Kirkland and Ellis people are salivating because they see a line of bankruptcies of those companies coming, and most of them are going to be liquidations.
Rick, do you have a podcast by any chance?
I teach at FAU. You can come to my class.
Okay, I was like, do you want one? Because I would listen. Marco, go ahead.
I guess one of the recent challenging acquisitions was a telecommunications company. And today's when you're looking at telecoms all over the world, there are VMOs as well, virtual mobile service providers that tap into this infrastructure that already exists, satellites and antennas worldwide. So we bought a company from a very famous guy in Italy that unfortunately didn't disclose everything when he said he did, and his lawyers also lied. So now we have taken over the whole company based on a breach of contract. So there are opportunities even when they're lying and they're coming to you with things of the sort when they're not disclosing information properly. And so today we have this telecommunications company which is called LE Mobile, and is one of the fastest growing telecom companies, similar to Mint with Ryan Reynolds. I'm sure you guys have seen that. So it was bad, but that was cool.
Okay, that's good. You spun that one. I'm impressed.
I have mud in my face. So a friend of Marty's, who I know well, very respected New York family, we invested about $650,000 into a water filtration device based in New York. And there was all sorts of things in the diligence that worked well. However, the management team was older than Moses, everyone. And when they were going through the road shows, if you know anything about real estate, sometimes the copper plumbing is worth more than the house. That makes sense? And the copper plumbing here was the $14 million in IP. So they were having a hard time selling it because these guys wanted to keep their jobs. And so one of them, a board member who was very wealthy, and because the family that we went in with, who led this investment, the person wasn't really paying attention, even though he sat on the board. What happened is the board member offered a loan for $1.4 million securitized by $14 million in IP. And so what happened is it was a UCC one foreclosure, if you know anything about that, and they just took the assets out from underneath us, and it became an issue. And my general counsel of 15 years has been on it. But when this happens, people hate you, but you turn it around quickly. by just being honest and upfront with them. And since then, we've been able to put them into founder shares and other things that we've invested into that are doing really, really well. So there's always a way to counteract that. It's just whenever you have a problem in life, just make sure you don't go up and tell a person you have a problem. Come up with like at least 2 different solutions, so that you can, at least show that you're thinking about it. But everybody's happy now, and they're all in our other deals. So.
And for those keeping score at home, the moral of the story with all of these stories is have a good lawyer. As a jurist myself, maybe I'm biased. So let's flip the question, and I don't know how pressed we are for time, Marty. How and when you want to, kick into
25 minutes.
Okay, 25 minutes. I've done more with less. So to flip the question, Sal, what is a deal that you did, and for all of you, what is a deal that you did that you said yes to that you're very proud of, and especially one that you've done recently? So like a success that's on the board that's already seen that success, and one that you're hoping will, and are optimistic that we'll see that success.
There's 2 of them actually. One of them is Thrive Bioscience that we're very happy about. It's going to be the founder's 18th exit and 8th unicorn, if he knows what he's doing. And he has everything put together well as far as his board, as far as the experience and the investors that he has. But the one that's most interesting is a company that we invested into called AI Scout, or AI.io. And what it is, it helps with recruitment for amateur athletes to be able to get into world-class, one of these, Premier League soccer or football. They'll be announcing an opportunity. They'll be announcing a deal on Friday with the NFL. I probably shouldn't say this, but we're very happy with the growth that they've had after they've captured Premier League soccer, cricket, and it also has like a social impact to it as well. Because if you have someone in an iPhone and you're in an impoverished city, say in East India, and you have one kid who's very good, it's actually a case study of that one child now playing for Burnley, football club. So, it's really interesting to see this happen in real time in AI. And at the time, I was kind of insecure because it's like, well, it was a year ago, and we just actually sent a wire out last week with an additional re-up for that company. And we have about 1.5 million into it, and we really like it. We love the leadership, and we love the co-investors in it too, because the same ones that invested in that, it's a Raptor group. So we were following them. They invested in FanDuel and Fanatics, and very respectable in that space and kind. So I'm very excited about that one.
And part owners of the Boston Celtics.
Yes.
Fun fact.
For us, from a personal perspective, was reopening and rebirthing our OEM, becoming an OEM again, an original manufacturing company in Europe. So today we're leading the industry as the Tesla of motorcycles, what they call us in the media. We're ramping up. It's a multi-billion-dollar business for us ourselves. We're getting financed by groups in Saudi Arabia and the Emirates. So it's an exciting time to know that not only we've aligned ourselves in the market during this growth and this trend, but that the government's worldwide policies and regulations are, in essence, supporting such a thing. You were all aware that we all need to be electric by 2035, 2040, and 2050. So we're part of that trend, and I see the growth and I see the reaction that we're obtaining from world capital.
The best deal that I did was buying in 2009, 2.5 acres, ocean to intercoastal on Jupiter Island. As I watched the Palm Beach market explode, I knew the Jupiter Island market was next. And then I built the largest postmodern house on Jupiter Island and the highest house, and made 6 times my money in that time period.
In what period of time?
In about 7 years.
Are you still there, or
And I lived there for 2 years.
Oh, you're not still there?
Tax advantage.
Sure.
Our best deal, and this is on this is outside of the family office stuff. I've got a small investment banking team. Has anybody ever heard of Uncle Nearest Whiskey? Anybody?
Did you bring any?
I did not.
Okay,
but
then no.
So the Jack Daniels official story is that Jack Daniels left his house at the age of 13 to go live with Reverend Dan Call, and Dan Call had a side business of distilling whiskey, and he taught Jack how to do it. But the true story is that Dan Call's head slave, Nearest Green, was actually the first African-American master distiller in 1856, and it was Jack and Nearest became fast friends, and he learned how to do it. In order to be considered a Tennessee whiskey, you have to distill over maple charcoal, and distilling anything over charcoal is an old island trick, and Tennessee has maple trees. So a woman named Fawn Weaver, an African-American author, read an article about Nearest Green. She picked up, flew to Lynchburg, sat in the library, learned everything she could learn. And then all of a sudden, the matriarch of Jack Daniels came out and said, "Why are you asking questions about our history, Nathan Green, Nearest Green?" So fast forward, we raised their Series A in 2017. And this year we just did a Series E. We're doing over 100 million in rev, and the story is getting out there, and it's fantastic. So that was our good story.
That is an awesome story. I wish I could end on that. I got to fill more time. So maybe that's what we're gonna do. So thematically speaking, going back around the snake draft, Sal, what are you, just from a sector standpoint, bullish on at this moment in time?
Life sciences, technology. Not so much real estate right now. I don't think you've seen too much happen as far as like clearing the market. There really haven't been a lot of bankruptcies. There's not a lot of banks that are really, they're not really selling anything yet. There really hasn't been that much opportunity. I think that much opportunity that I've seen, I think in a year from now, 6 months from now, it's going to be a different story. But I like the technology, I like the AI, and the life sciences too.
I guess the natural follow-up I forgot to ask, this applies to everybody, is why? What's the rationale?
There's a lot of smart money that's been going into it. To be honest with you, there's not a lot of smart money it's not as feverish as it once was. With life sciences, it's sort of a higher barrier to entry with these companies to get into it. It's not like somebody's starting it in their garage. So we like to come in a little later stage, like during the seed, or maybe not even say seed, but like Series A, to be able to participate alongside those families, because there's strength in leadership there, right? I mean, you're following them you're following them with their pocketbook, but it's also a good case too, because they're the ones who are continuing to foster these companies, and it's something that we like working with. Some parts of technology, entry level, we're not into, but we do like AI, as I said before, the AI Scout talking about our book, and we're also doing Stripe. We like that too. Stripe is a secondary. It's not going to have as much of a pop, but it's one of those things that's just revolutionizing the world, sort of like SpaceX is. There was $1 trillion that they've generated over the past year. It took 12 years to get there. It took PayPal 25 years to generate a revenue or to process $1 trillion in those proceeds. So you're starting to see a huge clip, and hopefully these technologies will still, they won't turn into, go the way of Snap or anything like that. But I think these are strong companies that are going to be around for a very long time, and that's what we like.
In our case, it's a twofold. One is creating the Soriano Global Alliance with companies of the likes of Roger Penske's automotive group for world distribution. Then we have groups like Pirelli Tires, for example, being part of this. And then the other arm would be creating synergies and bridging companies that are producing or supplying us. So there are new technologies, for example, Soteria Big, I happen to have the CEO here. It's the one technology in the world that is preventing batteries from causing fires. And that's a huge factor right now. And it's creating all the problems that we have in New York City, for example, right? Most of the fires caused by incendiary batteries. And we all know in the EV sector, or any of these batteries explode, lithium-ion based batteries, you can't put them out. So it's a big problem. So we're looking for technologies that are cutting edge, that are in synergy with what we're manufacturing, producing, and putting in the market in order to minimize the exposure of liability products insurance, which is very expensive, and also ensuring the consumer to be able to drive or ride that vehicle.
Okay, so the new era of mobility and sustainable mobility is the log line there. By the way, I would contend that the biggest problem in New York is not the fires caused by lithium batteries, or so people doing heroin in open daylight on the L train, but that might just be a me thing.
I'm sorry. The biggest problem is the bike lanes. Yeah. That were organized for bicycles, but they're all e-bikes now. Go like 30 miles an hour down the bike lanes.
Yeah, then we might be doing like the coastal elitist thing right now, so that's my fault, and we can move on.
Yeah, we like life sciences also, but only when there are other big names in there, because we feel that that's a controlled business. We sometimes get a deal with the Gates family office and this family, and they just control the ability to take those companies public. They know the buyers. We can't do that, so we get small slivers of that. We like it. We really do like private lending. Small managers, small amounts, carefully vetted deals. And then in terms of a short, we think that high-end real estate, the stuff around us at Palm Beach and Jupiter Island is a short. It ran up. My first property I sold doubled after I sold it, and then I bought another property and it tripled. So that's way too dramatic a move. Right now, you're looking at the trade from New York to Florida not being a trade. High-end Connecticut real estate sells at 1,100, North Shore, Long Island, 800 to 900, West Palm Beach, 2,000. So that's not a trade people can do anymore. Insurance in South Florida is completely out of control. If you have a mortgage, or if you live in a condominium that does have a mortgage, or a gated community that definitely has insurance, those have tripled in the last 18 months. So the expense of holding those properties has gone up. The market's flat now, and that's because there's no sales. The next move is down big.
So before you answer, Chris, this is just a PSA, is that, maybe another call to action around interactivity. If you guys have questions, just fire them off. I can't see the whole room, so you might as well just shout at me. But go ahead, Chris.
I agree with health. I think that I think in terms of healthcare and tech, the merger there, I wear an Oura ring. I don't know if anybody else wears an Oura ring here, but I always, and this thing is fantastic in terms of the data you can collect. It's like an Apple Watch, but it's just, for me, it's better on the ring. It gets a little bit of a crisper data set. But I always sit there and say, this is the flip phone of wearable health tech. And we all know what happened in 10 years to the iPhone, so technology grows exponentially. So probably in the next 5 to 6 years, God only knows what these wearables are going to be telling you in terms of diagnostics. Now, what we all do with that data is a whole other story. The other theme that I like is the repatriation of manufacturing back to the United States. Everybody knows that, prior to the peace dividend, with the fall of the Soviet Union, the world traded in blocks. And when the world trades in blocks, that's an inherent tax on the system. And I think, unfortunately, we're going back to a world where we're trading in blocks. And one of the reasons why we probably need higher interest rates in order to, keep that flowing. But it's a tax on the system. We're gonna have to do stuff at home because it's just going to become too expensive to continue to do it offshore. And I think, there's also some businesses that we need to repatriate for national security, reasons as well. So.
Yeah, I got a quick question. So, all of you guys have alluded to it, which is how important is who's on your capital stack review, right? Because you just mentioned if I'm doing healthcare, Gates has got to be in it. You mentioned it, Louder's got to be in it, right? I mean, can you talk about that? Because there's been this tremendous explosion of like crowdfunding. You've got somebody who's got a small stake who's going to sue you.
It's just the smaller the check, the more the pain they're going to be. This is the way it's always been in anything that you sell, retail or otherwise. And to me, that's the cap table is the soul of the asset. If you can remember that, then that's probably the most important thing. And we're behind some very big prominent families, but we're also at the board, which I think is the conscience of the asset of the company, is stacked enough to make sure that we're able to, negotiate these sales to, larger multinationals. A lot of these guys put together companies, they run away from big convents like, Cardinal Health, and then they start their own, convent only to sell back to Cardinal Health later. So they know what's going on. It sort of knows what they're building. That's one of the cases of one of our companies called Immunicom, which is doing well. But, when you look at the other ones, if it's a bunch of $25,000 slugs or $50,000 slugs, where's the real depth when things happen? Where's the real depth when Silicon Valley Bank blows up? Where's the real depth when interest rates go 550 basis points? Who do you really want to be in bed with at that point? A bunch of, middle-class investors speculating for middle America, or sophisticated investors who've done this before and have the deeper pockets and the understanding and the sophistication to see this through to an exit?
The short answer to have big names is always health, right? I mentioned Roger Penske, who owns NASCAR and distribution rights globally for BMW, Mercedes-Benz, Maserati, and Porsche. So yeah, it makes things easier, 100%.
The due diligence that they can do. One of our people has 4 Nobel Prize winners in his stable of people who review deals. we can't repeat that. And then what I find is those people align with each other. So there's a billionaire in Palm Beach who's part of the Bill Gates team, part of the Michael Dell team. Then we have 5 big names in there, and they've got like 6 million left to fill out the deal. Actually, I'm relying on their due diligence. I'm not doing my own, and I'm comfortable with that. It's worked multiple times, but on our own, we'd never do that deal.
Chris?
I'm not really big on confusing a W-2 with intelligence. So what we look for in terms of the cap table is more strategics, right? I mean, they may or may not have the size of Bill Gates or whatever, but as long as there's some, core strategics in there that can actually help the company grow. And you're starting to see this trend a little bit with the OpCo market. I think that was spoken about yesterday. You're seeing a lot more people when they're getting involved in a certain project, they're like really taking an interest in other aspects of it as well. So for me, strategics on the cap table matter.
For those wondering, I didn't walk off. I just went to go get a question from the audience. So I'm doing my daytime talk show thing. Sir, tell us your name and where you're from.
Eric Metzger, Merlot Partners. Question for Richard. What do you attribute from the scalability of where your property was to doubling and then doubling again? Is it the underlying land underneath the home that's the main factor, or is there other factors involved?
I contribute COVID, as I said, was, some we like to say we wish we had more of it, we don't, but it was the greatest wealth generator of my lifetime. People from New York, for whatever reason, taxes, the dynamic of Florida, the ability that Florida was no longer a place for old people to die, moved in droves and paid crazy prices. Real estate I bought a house in Palm Beach 20 years ago for $428,000. I sold it for $5 million. I thought I was a genius. The woman who bought it owned an antique store in West Palm Beach and just resold it for $9 million. Okay, that's all in a 4-year period. So that level of price appreciation is not repeatable. It's a result of wealth creation, okay? The same people I said have what I think is scam company, sold in the IPO and each made $100 million. They turned that into real money. They took monopoly money and bought houses in Palm Beach and Jupiter Island. And that drove up in a very small market. Palm Beach is 4,000 houses if you count everything. Jupiter Island is 800 houses if you count everything. Small markets, people had to be there. And like Manalapan, that was an area which people didn't want to live in. It's filled. The land is subsiding. There's a theory that in the next big hurricane, Palm Beach will split apart at Manalapan and the ocean will come into the intercoastal. That was the big theory. The land is swampy. Guy who almost bought my house paid $70 million for a similar house on swampy land in Manalapan. So it was a mania. It can't repeat itself and it has to reverse itself because we won't have wealth creation like we did during that time period, again, probably in my lifetime, because the Fed realized it made a giant error, leaving interest rates at 0 for that period of time, and then helicoptering in $7 trillion. That's inflation, people. That's asset inflation.
Well, I think one thing we're also bringing is a SALT cap.
The
SALT rule that Trump put into place, we can only deduct $10,000 from your taxes. Whereas if you live in, New York State and the suburbs, your taxes that you pay for real estate are $70,000, $100,000 on a year annually. On a house that in Palm Beach would be, pretty nice. So, but it's not a great. It's just an average house in Westchester County. So that SALT tax has really been.
Salt was definitely.
It's a contributor to people to Florida real estate taxes.
Well, demographics. Everyone's getting older. COVID.
Yeah.
And New York is not New York.
I think even super rich people realized how much money they could save by not having. Remember, the New York State tax is a flat tax on whatever you earn. And then there's an estate tax on top of that. So people wanted to get out of New York State before they died. New York State's trying to trace some of those people and go after their estates for the time period they lived in New York, California too. It's not likely to happen, but it's thematic. I think people realize that that's a good trade because Florida is okay to live in. And COVID was the push. But the level of price appreciation, again, the woman trying to sell my house now for a lot more than I bought it is a billionaire. I think it's a toy for her. She hasn't gotten a single bid. I think the next movement for prices when the next block of high-end houses and condos in Miami Beach, houses in Palm Beach. Ocean Intercoastal Jupiter is down, and then down 20 to 25.
Well, like I said, since I was born in Miami, condos on Collins Avenue were selling for $70,000 in 1962.
I bought one, 165 Collins Avenue.
Right, and then 20 years later, they were still selling for $70,000. Now that condo today sells for $3 million.
I don't want to interrupt your Miami real estate conversation, but we do have a question.
Real estate is pretty well covered today. Just three sectors that I think you haven't touched on particularly, just interested in your views, no particular access to ground about any of them, no particular order: defense, impact, and crypto blockchain, as opposed to AI Web3.
Marty, do we have time for all three of those, let alone one?
At least, yeah, sure.
Or one, let alone three, sorry.
A great question, thank you. Disrupting technologies that are being used today in transactional fees, for example, I think, and we have done this to all of our companies, is setting up payment systems where crypto is accepted as a form of payment and leverage that out internally to be able to produce in our case, right? So out of the 100 first motorcycles we sold, about 25% of that came from crypto. And I was very impressed that was the case, but you need to have that in place. The metaverse, which I know a lot of people are not too keen about it yet, has become also a space where you can virtually transact dollars to euros, to USDTs, to any other type of cryptocurrency. The idea is to have that access and be able to exchange without, why would I need to pay fees to a bank to withdraw my money to take it overseas? And here in the United States, we're limited to 10,000 US dollars. Maybe I need 20 or 50 when I travel. Why would I have to want to pay those fees or exchange fees between currencies? So we're looking in so many different ways where the metaverse, the blockchain creates this transparency for transactions all across our businesses.
I'm not allowed to talk about crypto at this meeting, so I won't.
Yeah, you almost caused a riot last year.
In return, I think in terms of defense, I think we've seen a little bit run up on some of these defense stocks. I mean, we've given Ukraine a ton of stuff. Now we're giving Israel a ton of stuff. I think we're mobile. I mean, there's obviously going to be some replenishment there. So I think you'll see some continued growth. Again, I think there's a lot of saber rattling around the world. And then you do have the military industrial complex, so they get a blank check. So, I mean, they will spend it.
The problem with defense spending, defense companies has been their valuation is high from the beginning.
Yeah.
I mean, it's really hard from the beginning to invest in them.
But I did hear something recently that somebody was saying that they're worried about military towns because the future of the armed forces is not mobile, not bodies, because it's all going to go to more drones and robotics and all that kind of stuff. So I don't know what that affects, but I think from a hardware perspective, you're going to see some continued growth, specifically in the drone space. And in crypto, I don't know. I mean, we've had one counterfeiting ring with the Fed. I don't know if we need another 30 other ones. So
I guess the answer to the age-old question of war, what is it good for, is profit. Now, that one was just for me. I don't care if you guys like it.
Oh, boy.
Great. Jason Ma. Of course, the real estate is well covered, some tech as well. What do you guys think about, from an investment standpoint, private companies, defense, tech, innovation, and also next generation nuclear energy? Any perspectives?
I'm sorry, I'll just jump in. The small nuclear, tech is pretty compelling and interesting, right? But I think the country just needs to get over that psychological barrier. But I mean, if you think about it, we have battleships, we have aircraft carriers and submarines that are driving around for 2 years, and they don't need to go to port or anything. They don't need to be refilled. So I think there's been a lot of schematics and some articles on that nuclear stuff, and it could be a game changer, no question. And I think it's an interesting to look at. I mean, obviously it's nascent at this point in terms, I think, from an investing standpoint, because there'd be like way too many regs. I mean, you can't even get, I mean, God, you can't even get anything built in California. Can you imagine trying to get a nuclear thing built there? And then defense tech, like I said, I think it's all going drones and smart, smart weapons and all that kind of stuff.
I have one comment.
Sure.
So just in keeping with what Russell Deacon was talking about earlier, which is that, the bankers will always say what they're gonna do, what you need to do to generate fees, right? So it's always like, economy goes down, rotate to international, rotate to this, rotate to credit, blah, blah, blah. Everything's vintages, right? You invest in crypto in 2013, you did pretty well. 2007, you invested in micro technology, et cetera, social networks. And so what's going to be the vintage for the next 2 or 3 years that you think you need to invest in? Any thoughts?
No one brought me here to answer those questions, so here you go.
That's great.
What's the vintage for the next 2 or 3 years? Like, what's the thematic thing? It was social media, 2010. It was single family homes in 2014. What's going to be the theme?
Thematic research today, what we're looking at is nano satellites, for example, in terms of telecommunications, where individuals or companies can afford to have their own satellites and communicate and have privacy.
So right? The size of a postage stamp, it pings off and sends messages.
Exactly. So we're looking at paradigms that will change the society. And this goes back to the thematic research on disrupting technologies in given sectors. And that's our approach. And that's really where
I think space is huge.
Yeah. SpaceX was our foray into space, but one of the companies that we're looking into right now, we actually might have secured an institutional investment for, is a company called Air Matrix. And what they do is they basically plot out the skies between 300 feet and 7,000 feet. And the play on this, which is interesting, is that municipalities like to license this, top cover, for this, because they can generate fee revenue off of it. So there will be a time, and I think it's the same thing as what this gentleman was talking about today. People can't really visualize drones, delivering things. I know in Miami, there's these little igloo coolers that are autonomous that deliver your food. I don't know if anybody's ever seen that. Yeah, but you're gonna see that with drones soon at some point. And I think for the next vintage, it's gonna be the combination of AI and logistics of putting that together. And even though it's a younger team and we like them, it's something I'm fascinated with, to be honest with you.
Rick, your thoughts? It's a short-term credit?
Yeah.
Private credit?
Yeah. I don't think that's a theme. It's a wrap around.
It's a rotation, yeah.
I think the street would want you to believe that it's AI, but I don't see it because it seems like it's a little. I don't really think it's crystallized yet. I think that because the world's been kind of murky. I think we're still trying to digest these interest rates. I'm not saying that there's not a phoenix coming from the ashes for the next round. I just can't put my finger on which one it's going to be.
On my cue.
Are there more questions? I think, or maybe just have people wrap up and there's no question.
No, I don't think there's need to wrap up. I think the way, unless you guys wanted to plug something, I think you've done a really good job, Marco. But if there's anyone else that wants to plug something, by all means, and then we can give these guys a round of applause right afterwards.
Thank you.